Crude is down, tariffs are up, and Suncor just filed an application to more than triple production at its most profitable asset. That tension is not accidental, it is the entire story. The consensus read on Canadian oil sands right now is straightforward. U.S. tariff escalation compresses margins, WTI softness squeezes cash flow, and producers should be pulling back. Canadian Natural Resources validated that narrative earlier this month when it paused the planned $8.25 billion expansion of its Jack Pine mine, citing policy uncertainty and calling for an end to carbon pricing. That is a rational, defensible decision from a major operator. Suncor went the other direction. At its March 31st Investor Day, the company announced a 3-year plan that targets 100,000 additional barrels per day by 2028, a $2 billion increase in normalized free funds flow, and a 20% increase in annual share buybacks to $4 billion for 2026 alone. The stated WTI break-even target is US $38 per barrel by 2028, down from current levels by US $5. And the company filed a contingent resources report disclosing 30 billion barrels of oil sands resource, an 11 billion barrel increase, with no exploration risk attached to it. That last number deserves a moment. 30 billion barrels, with no exploration risk. That is not a speculative reserve. That is identified, mappable resource sitting inside acreage Suncor already controls. The market has spent years asking whether the growth runway was running out. That filing is the formal answer. Now here is what most analysis is skipping. The split between Suncor and Canadian Natural Resources is not just two companies making different bets. It reflects a deeper structural divergence in how oil sands assets age. Canadian Natural Stack Pine Pause is about a greenfield mine expansion, massive upfront capital, long construction lead times, high sensitivity to policy and price. Suncor's growth is almost entirely organic, coming from existing infrastructure, new well additions, and incremental steam technology at assets it already operates. CEO Rich Kruger was explicit about this. No major acquisitions, no massive capital projects. The phrase he used was just doing business better. That is not modesty. It is a deliberate signal about capital intensity, and it matters enormously under tariff pressure. When external costs rise and margins compress, the companies that survive best are those whose incremental production cost is the lowest and whose assets are the most integrated. Suncor's vertical integration, from oil sands through upgraders to refineries to its Petro-Canada retail network, means it captures value at multiple points in the chain. When crude benchmark prices fall, a pure upstream producer takes the full hit. Suncor's downstream absorbs part of it. The Firebag site is the specific engine here. Currently producing around 215,000 barrels per day through steam-assisted gravity drainage, Suncor has now filed to increase the production limit to 700,000 barrels per day. The additional wells, new steam technology, and solvent injection improvements are projected to add nearly $400 million annually in incremental free cash flow by 2028. That single asset is doing more work than many entire companies.
And Firebag is in situ, not mining, which connects to the longer strategic signal that most commentators have noted but not fully weighted. Suncor CEO said on the Investor Day conference call that by 2040, the majority of oil sands production will come from in-situ operations, not mining, as the base plant mine depletes within the decade. That is a structural shift in the company's cost and carbon profile simultaneously. In-situ SAGD has a lower surface disturbance footprint and, with solvent-assisted processes, a lower steam-to-oil ratio than conventional SAGD. Lower energy input per barrel is both a cost lever and a regulatory buffer. Fort Hills is also being pushed from 175,000 to 200,000 barrels per day by 2028. The refining network is being expanded by 10% in nameplate capacity to 511,000 barrels per day. The entire architecture of this plan is about extracting more from what already exists, rather than betting on new terrain. CIBC flagged Suncor as its top pick among Canada's oil majors in this environment. That call was made in the context of a global energy market already stressed by the war in Iran. Now the two scenarios. If WTI stabilizes or recovers, even partially, Suncor's low break-even target of US $38 gives it operational buffer that most peers cannot match. The $4 billion buyback program at that price level is not just a capital return mechanism, it is an earnings per share accelerant. Fewer shares outstanding amplifies the cash flow improvement on a per share basis, and that is where the real shareholder return story lives over a 3-year horizon. The harder path. Tariffs escalate further, WP is pressured, and Canadian heavy differentials widen as cross-border pipeline economics deteriorate. In that scenario, the break-even cushion matters less than liquidity. Suncor's integrated model and its refinery exposure to Canadian end markets provide a partial hedge, but it is not a complete one. The company would still face margin compression at the upstream level, and the timeline for free cash flow growth would extend. What makes the tariff pressure more nuanced than it appears is the Iran war backdrop. The global crude market is not in structural oversupply in the way that crushed oil prices in prior cycles. Disruption to Iranian exports has tightened certain grades. Canadian oil sands production, heavy, reliable, politically stable by global standards, occupies a specific strategic position in North American energy security that becomes harder to substitute as Middle East supply uncertainty persists. That is the conditional case for resilience. It depends on North American energy security logic holding inside trade negotiations, which is not guaranteed but is also not irrational to expect. The picture that emerges is not one of a company ignoring risk. It is one of a company that has spent 3 years reducing its cost structure and extending its resource base, and is now choosing to lean into a period of volatility from a position it believes is structurally stronger than the market is pricing. Whether that confidence is warranted will not be decided by the Investor Day presentation. It will be decided by WTI, by tariff resolution timelines, and by whether Firebag delivers on the production curve that has been filed with regulators. The divergence between Suncor and Canadian Natural Resources is now a live test of two different theories of how to survive the same pressure. Both companies have made their argument. The data will arbitrate.